My entrepreneurial journey began in the year 2016. My friend had opened a bar and she wanted someone to supply snacks. So she approached me and asked me if I knew someone who'd deliver. She wanted samosas. We had never made samosas before. I went online and got a lady. I asked her if she can train me how to do the whole process. The samples that we did, I took to my friend, and my friend liked them, and that is how she gave me the job. After that, I started posting samosas online. I got a lot of orders from friends. They were my first clients. And I told myself, why not introduce more snacks, more variety. Then just before COVID, I told myself, let me get fish and sell to my neighbors. I remember there was a client from Syokimau. So the client was like, Jackie, where can I get the fish? I want to come and pick them myself. So I had that choice of, am I going to let people come to my house, or am I going to get a small place and just start from there? So we started scouting for a restaurant. We got a place just in Kitengela, and it just progressed very smoothly. Then COVID hit, the restaurants were closed and all that. After COVID, we opened our doors again, and we got a lot of referrals, and we saw the need of us moving from where we were because the sanitation wasn't proper for a restaurant. So we began scouting for land. That's how we came to our new location here in Kitengela. I managed to get funds from my sources and put up the structure. But still, I had that need to have more financial aid. And I approached a friend who then recommended Stanbic. I walked to one of their branches and I spoke to the manager, who then took me through the products that are suitable for my business. And I managed to get one, and Stanbic came through for me. Through their financial assistance, I've been able to employ more staff. So that has really contributed to more orders from corporate, and I'm able to deliver timely, and this has opened more opportunities for the business.
The thrilling world of businesses in the city. Mato, you on speed dial. Looking for help with his LPO, he needs to deliver laptops fast. Enter Stanbic Bank, the game changer in LPO financing. And I get to expand his horizons. Huyu hapo ni Max, aki-import bills, lakini yuko in a tight fix, like his favorite pair of tight sweatpants. Working capital solution from Stanbic Bank in a come through. Sasa and expand his fashion empire to the max, literally. When our dada, a mobile money super agent, gets frantic calls to Hawana Float, through our digital solution, MJK Dada Boss can send float to a sea of agents to keep them all afloat. Grow your biashara and unlock your horizons with our payments and collections, vehicle and asset financing, unsecured bid bonds, LPO financing, insurance, cross-border solutions, and so much more. Stanbic Bank is regulated by the Central Bank of Kenya.
Testing. Ready? Kevin? We go. Okay. Good morning, ladies and gentlemen. My name is Lilian Onyach. I serve as the head of brand and marketing at Stanbic Bank. I'll be moderating the session today. I'll start by thanking you for joining us today. Following the review of our security situation in the country and our concern and safety of our stakeholders, we have reviewed the format of our investor briefing today, and the session will be fully virtual. And you can engage us on all our social media platforms. We are live on Facebook, we are live on Twitter, and we are live on YouTube. We are pleased, leading in our legacy of being the first bank to announce their results today. But we do it with a lot of appreciation and knowing the critical role that we play in easing and responding to the economy and the communities that we serve. Today we'll take you through operating environment that will be done by our Regional Chief Executive, Mr. Patrick Mohere, our strategy. We will take you through our performance, our growth drivers, and our targets. And to cement our fidelity to driving shared value, we will highlight the impact that we have created in the communities. Today's session starts with opening remarks from our chairman. Our chairman is somebody who is not new to the media community and our stakeholders. I therefore would like to invite our chairman to give his opening remarks. I'd like to invite our chairman, Mr. Joseph Muganda. Thank you.
Good morning, everybody. Invited guests, our esteemed shareholders, investors and analysts, fellow board members, members of the media, Stanbic leadership team and staff, ladies and gentlemen. I'm honored to stand before you today as we introduce the 2024 half-year results of Stanbic Holdings PLC. It is a privilege to share with you the progress and achievements we have made in navigating a dynamic macroeconomic and financial landscape. The first half of 2024 was marked by resilience and adaptability in the face of various opportunities and challenges. The global economic landscape continued to be dominated by geopolitical conflicts and tensions, significant electioneering activity, and elevated interest rates. Notwithstanding these, advanced economies continue to register steady growth underpinned by increased consumer spending, investment, and government stimulus measures. Locally, Kenya's economic growth was confirmed at 5.6% in 2023 and continued on a similar trajectory, posting a 5% growth in the first quarter of 2024. And the key drivers are agriculture and the services sectors. Inflationary pressures softened from an average of 6.6% in 2023 to an average of 6.2% in the first half of 2024, eventually closing the half at 4.6%, mainly driven by lower food and commodity prices and a stronger Kenya shilling. The Central Bank of Kenya held its policy rate at 13% since January 2024, anchoring inflationary expectations. The economic uncertainties linked to the potential default of the 2024 Eurobond were quashed as we successfully refinanced and prepaid 75% of the debt in February and settled the remainder in June of this year. This sparked a 21% appreciation of the local currency against the US dollar between December 2023 and June 2024. The local currency was also boosted by increased dollar inflows from key strategic development partners under various lending arrangements. The country experienced catastrophic flooding between March and May this year, leading to loss of lives, damage of crop, property, and infrastructure. This degraded production, supply chain, and disrupted our supply chain, amongst others. The full effect of the floods are still manifesting. The latter part of the first half of the year was characterized by civil protests as citizens pushed back on the new tax proposals included in the 2024 finance bill. The bill, which the president eventually declined to sign into law, opened wider discussion around public accountability. The said protests continue to evolve, targeting different thematic national issues. The agitation has had an impact on business due to repeated operational and logistical disruption on certain days of the week. Despite the challenging environment, the banking sector continued to demonstrate resilience with increased profitability, strong liquidity and capital adequacy ratios as evidenced by the published Q1 industry results. On our end, Stanbic Holdings plc maintained its robust performance trajectory. The company achieved a monumental 30% year-on-year growth in balance sheet, closing the half just shy of the Kenya shillings 500 billion mark in total assets. Profit after tax grew by 2% in the period of account on account of rising interest income, muted non-interest revenue, and judicious cost and risk management. These achievements cement our resolve to continuously provide solutions to our esteemed customers and society at large during the difficult economic times. On the back of these results, it gives me great pleasure to announce that the Board of Directors has approved the payment of an interim dividend of Kenya shillings 1.84 per ordinary share, being a 60% increase from the Kenya shillings 1.15 as interim dividend in 2023. The decision underscores the board's balanced approach to managing the company's growth needs versus shareholder returns expectation. Looking ahead, we remain optimistic that the current challenges will be resolved amicably and sustainably. Our teams remain vigilant on emerging opportunities to support our customers and deliver sustainable growth. In closing, I would like to express my deepest appreciation to the entire Stanbic Holdings board, management team, and staff whose dedication and hard work have been instrumental in achieving these results. I also extend my gratitude to our valued customers and stakeholders for their continued support and partnership. Together, we will continue building on our successes through our shared vision of driving excellence, sustainable growth, and value towards even greater heights of success in the Kenyan banking industry. Finally, I would like to thank the government and the regulatory bodies for their mutual trust, guidance, and support. Thank you.
Thank you very much, Chairman, Mr. Joe Muganda. We will now get the operating environment for the region from our regional CE, Mr. Patrick Muhere. Patrick, karibu sana.
Morning, ladies and gentlemen. Thank you for joining us this morning as we announce our first half 2024 earnings. I'd like to just give you a little bit of a regional perspective, global and regional. As you know, things have been a little bit extremely, should I say, geopolitically challenged, whether it's next door in Sudan, the Russian-Hamas conflict, and all those have had some dampening on GDP growth, generally speaking. But having said that, I think the world economy is expected to grow at 3.2% annually, which is not a bad number given all the pressures that we're facing. If you move to the left-hand side of this slide, the one thing that we've seen that's kind of been sort of a disappointment in a way is the stubbornness of the regulators in moving the Fed rates down quicker. So one of the challenges that you find emerging markets or the countries in this region facing is that even though we see inflation down significantly, you can see Uganda is at 3.9, Tanzania at 3, Kenya at 4, we're unlikely to move significantly on the interest rates because of the strengthening of that dollar. So we kind of need those two things to work together. We've got to start to see, and we believe by September, the US will start to move rates lower, because that keeps a little bit of pressure on the currency and kind of puts central banks in a bit of a squeeze in what sort of, what choices do you make? Do you try to reduce your interest rates and then compete with a significantly powerful dollar? And that has had an enormous impact on where we end up. The other thing, though, to point out here is that you see that GDP growth for East Africa is expected at around 5.6, which is double what the global rates are. And then lastly, on the reserves, again, you'll see 4 months is generally what I would expect to cover, and you see that Kenya is right there. So Tanzania is doing reasonably well with 5 months, and Uganda is a little bit lower than that. Moving forward, again, this sort of kind of reconfirms what I was saying earlier. While we have a resilient economy, and by the way, the central bank just confirmed that we will see a 5.6 or 5.4% growth for this coming year. So we're generally going to see 5 to 6% growth in East Africa, which is quite, I think, remarkable given the pressures that we're facing globally. And with lower inflation, strong reserves, with the, I think, star performer being the Kenyan shilling, which was up 17% year to date. And you can see there from that chart in the middle, at some point when we last spoke, we were staring at 160 in the face, and now we're looking somewhere below 130. So a very, very good outcome in terms of how we've managed the exchange rate. But therein also lies the rub. Again, you have to sort of make some choices there. If you look at private sector credit growth, 4% is a very, very low number. It's less than inflation. We got used, and I think we got spoiled in the Kenyan banking sector at growing at double digits, either low or middle double digits, 14-ish%. So the fact that we're at that rate is quite challenging for banks. But at the same time, you can see the NPLs at 16%. That's also a number that's quite worrying. Fortunately, we're playing at around half that number, NPLs for the bank at 9% area. So again, we expect that as we see the global trends move down and we start to see the softening of the dollar, it will allow our local central banks the ability perhaps to start to lower rates and then increase sort of the private sector credit growth. But also that cannot be put in isolation because it definitely has something to do with all the disruptions we're having. Some of the economic activity has been dampened in particular industries. The floods, civil unrest, and also the downgrade that we got from the sovereign. So we are expecting to have a reasonably challenging second half of the year. But I must say that we're pleased with how we've been able to navigate the first half of the year, given all the challenges that we've faced. And then just as I try to conclude, just to remind everybody, this is sort of the one-pager of our strategy for 24 to 26. So we want to definitely, the three things that we focused on, our strategic priorities are continue to transform the client experience, execute with excellence, and then drive sustainable growth and value. I'm happy to report that we're doing quite well on all of that. If you look at our revenue growth rate of 14 to 16%, that's 10 percentage points above inflation. So it just means that we are stealing some market share, and we're growing significantly faster than the market. Our Net Promoter Score of 50, which is we're above. Again, it's another way of sort of measuring how the clients are experiencing us. And we are getting very, very good and positive feedback. On the cost-to-income ratio side, we're getting into the low 40s, which, you know, even if on a global basis you were to compare, is a very, very remarkable outcome. So we've been able to manage a lot of the costs, keep the revenue growth numbers at a pretty healthy clip, and then just manage as we work through the economy. Again, I touched on the NPL ratio at 9%, significantly lower than the market average of, call it, 17 to 18%. I'm happy to report as well, we're now getting closer, we're above the 20% ROE mark, which has always been something that has been a huge target for us. And we expect that in the near-term future to touch on that mid-20s ROE. So, in summary, we're very well positioned for the future. We have a very healthy and fortress balance sheet with very strong growth prospects. a good client base that not only trusts and believes in us. We have a very robust business model beyond banking, invest, insure, and all the other types of businesses that are beyond your commercial banking. And we remain a very, very trusted brand. So we're looking forward to a second half of the year. Very pleased. And again, I'll just, in summary, just show you kind of where we sit on those targets. You can see we had a 38% growth in revenue, first half of 2023. That is significantly higher than our target. We are running obviously lower the first half of 2024, but on a compounded annual growth basis, I think we'll always get back to that 15% CAGR, which is our target. On NPS, we're targeting 50. We came out at 41 for the second half of 2023. We haven't done the numbers obviously for 2024, but we expect to have an improvement in that. And then, you can see in the cost-to-income ratio how we came nicely from almost 50% down to 40. Reducing your cost-to-income ratio by almost 1,000 basis points is no small feat. And special credit goes to Joshua and his team for managing that significantly. I've touched on NPL and also on the ROE. So in summary, very pleased with our results, and I'm going to now invite Mr. Dr. Joshua Igara to come and give us a little bit more detail on that. Thanks for listening. Joshua.
Thank you, Patrick. As we invite Joshua onto the stage, I'd just like to remind all our audiences online to please send in your questions through the chat platform. Please do send us your questions, whether it's on Twitter, Facebook, or YouTube. Please do send us your questions. Thank you. Karibu, Joshua.
Thank you very much, Lillian. Let me just make a couple of remarks to support and maybe to explain. The chairman has set a very good foundation on the environment we find ourselves. And I know a lot of our investors are looking forward and say, okay, what is the resilience of the businesses and the strength of our ambition and strategy that we have? And these headwinds are very global. Most of them, as you look at this moment, and just my slides first speaks about our ambition from the last meeting we held when we spoke in the month of March was about working closely with our clients and supporting our clients in the environment of headwinds. And that story is what you'll hear speak about our strategy during this period. It's important that when the environment remains very tight, the operating environment remains complex, how do we support our clients to go through this moment? And we are a very long-term business. So when you look at our size of growth on our balance sheet, which is a very solid 30% growth year on year, the chairman spoke about just shy of $500 billion. It just shows you the momentum of the business environment that we have across all our business segments, whether it's our largest clients, our medium-sized clients, our personal banking clients, and our insurance and management business client that we have. And if I just speak a little bit more about what we've seen, Patrick mentioned a bit about we continue to grow our client numbers over the period, which is a good moment to see. So an 18% up, a strong double digit in terms of our client portfolio through this period of time. It just shows you the agility, the ambition of our clients that we have across all segments. For me, it's exciting to see many new clients that are coming through, whether they're on a large segment, the corporate banking clients, investment banking clients, or even just your individual clients coming across our networks. And maybe what I will summarize is that momentum shows the strength and the organic growth ambition of our business into the medium term. It's an exciting measure to look at how our business continues to grow. In terms of just our footprint, I just like to mention one item, which is digital transactions continue to become, we've been investing strongly in the last 2 years on our digital channels. We just launched a new platform for our clients, for personal banking. And that you will see that, over 10% growth in transactions year on year. That's not on the slide. And you will see that we are now just shy of 10 million mobile transactions. And that will continue to be the way we serve insurers and organizations. But the input of this slide is that we will, as long as we are seeing clients growing, a strong 18% growth in the market, as Patrick said, it's a strength to grow our market share in all segments, especially on our personal private banking segment and our SME segment as well. Let me remind you just about what Patrick spoke about our markets. The strategy that we have for the short-term period or medium-term period remains the right one. Headwinds do arise, and that's the value of having, the board and management that looks way beyond an environment that we have. So 14-16% revenue uptick in a 3-year cycle is a very strong moment, both ahead of inflation and just generally ahead of what market is in our region where we are. And that's what we continue to commit to. So you may see, this period, and Musa will speak around about our performance in the period. You will see that generally, cost of funds have increased and operating environment remains complex. And that doesn't stop us from just remaining focused on delivering the ambition that we have set. You look at our efficiency levels, 41%, 43% cost-to-income ratio. I love that we are pushing very strongly our NPL ratio, even to go below the 9%. And you will see that this year, Patrick mentioned about the strengthening of our currency very significantly in the first quarter. And that gives you two aspects. One is then your foreign currency portfolio kind of resets itself, more like a 20%. It kind of reduces because that's what has happened with the shilling to the dollar. And we continue to grow our local currency portfolio. And you will see that in my couple of slides as I say what we've done in our strategy implementation. So just 3 slides to explain how we've deployed our strategy. In this period, more than 54 billion shillings of new loans into the market to support our customers in this environment across various sectors. So our local currency growth of loans are up today close to 30%. And that's a very significant investment we continue to make, even in this environment that we see difficulties. Remember that our foreign currency portfolio has kind of reduced because of revaluation on the new exchange rates. And so you always have to monitor those two elements on our loan growth. Strong local currency portfolio growth, obviously that counterbalances reduction in our foreign currency because of the restatement of the exchange rate. Those are the two measures that are important. So that growth of 54 billion is what you should look at, the organic momentum. So, whether it's our farmers we are working with in agricultural sector, a lot of support. We are very well known as a bank to work. It's over 7 billion shillings we spent in that element in terms of just new loans and disbursement. We are one of the largest lenders for agriculture across many sectors. We hold that very long position for a long time. For SMEs, enterprise clients, and commercial clients, you can see a significant amount of facilities that we've been able to do in the first half of the year. So 25 billion shillings. And you can see new SME onboarding. We're working very closely with the Africa Guarantee Fund to support some of those clients. And that's the ecosystem that drives growth across many segments of our economy. I remind you that more than 80 to 85% of economic activity goes through that segment. We remain strong on our Women Empowerment Program, supporting them in terms of the investment and loans we have approved. We look at the investment in housing. You can see the loans that we dispersed in that area. Manufacturing and industrial growth for job creation is one of our very topical areas today. Different segments. And then finally on energy transition, whether it is largely oil, electricity, all those segments. As you see, a lot of investment for us. So that, I'm quite excited to see that even in this moment, our growth momentum is, our 54 billion just shows a significant growth in our asset portfolio that we have in this period. If I speak about just delivering on our strategy on using technology, and you'll hear this a lot from us most of this year, next year, we believe that that is really where the heart and mind of our client engagement will continue to be. So, we've done new products. I spoke about the mobile banking omni-channel that we have, which is a new Stanbic app, which is up and running a couple of weeks ago. It had some difficulties, but I'm happy that we are now, the teething problems are now behind us. We're pushing to get it done. We've invested into a new Flexi lending for our asset insurance program. We have a new investment program and trading platform with the SBGS app. So there's more work we're doing with the MJQ, which is a lending platform that we have for supply chain, for clients in SME and commercial clients as well. Trading platform, we call it EBB for working capital, the Chama app. So a lot of the work that you're going to see is that enables much more access to clients. That gives us a chance to grow in terms of our customers. And also that's important for us to be able to ring-fence the future orientation of our client performance and ambitions. And then that's where I wanted to focus a bit much more. So despite the challenges that we see, we're very much optimistic that actually we have a robust and resilient platform to be able to enable our customers to transact, to do cross-border trading, to be able to grow their businesses from strength to strength. And that is how we see the growth of the loans I spoke about in the first slide. Let me also speak about an important aspect of our ambition, because it's not just growing or building our assets just for the sake of growth alone for shareholders. Our organization, I spoke a few weeks ago around our sustainability priorities. I did announce about our commitments, the progress we've made. And I just want to use this moment to again reinforce the message that financial inclusion remains one of our key ambitions in terms of how we grow and catalyze different parts of our economy by working with smaller businesses, startups, catalytic funding for themselves. We also spoke about digital literacy, bringing in technology to support TVETs. Just the other day, we worked with the a county government just to be able to build a program to enable them to access skills, work internationally, support other markets from our young people. So that's the second kind of pillar for us, renewable energy, transition into just energy transition, and maybe renewables into solar, into wind. So an area we are very much well known for, and we continue to do in the next 3 years. And then finally, just make sure that we are training people financial literacy and financial fitness. So those will remain areas we want to invest much more in the medium term. And this is just reinforcing what we mentioned when we launched our sustainability report just a couple of weeks back. So that area remains. So those are the 3 ways of how we are deploying and implementing our performance and implementing our strategy. I just want to leave you with one slide, which is we continue to remain very solid in terms of our international credibility. So even in this moment, our investment bank has remained a solid, enabler in terms of just advising, building knowledge on investment banking team, supporting different initiatives. So, this February we were recognized as the best investment bank by EMEA Finance Africa. Is one of the global awards that you will get. We've also been able to get in recognition for the best international private bank that's early this year, April this year, by the Euromoney as well. And then, we've been rated here locally as the best bank to borrow from in the first half of the year by Think Business Awards. And finally, we was first runners up at the best impact investing initiative. So as a bank and as a franchise and as a business that you invest in, we continue to showcase not just in our local market, but across the region and obviously across the global practice. So thank you very much, and I'll hand over to Dennis to proceed with our results for the first half. Thank you.
Good morning again, and thank you for joining us this morning virtually. Thank you, Chairman, for painting a picture of the operating environment. Thank you, Group CE, for speaking about what's happening in the region, because we are connected as a region, and that's how we operate. Thank you, Daktari, for kind of elaborating on our strategy execution. What is left now is the numbers, and I will take our investors and the media through the numbers. But before I do that, Lillian would like me to remind you to send through the questions. We are eager to answer to some of them and respond to things that matter to you. This first half of 2024, we saw our revenue reduced by 4% in gross terms. And that is actually a good performance, and I'll explain why. Our revenue, of course, is broken into two broad parts. The first big part is net interest income. Net interest income increased by 4%. And then there is non-interest revenue, which is fees and trading revenue, which reduced by 15%. Why am I happy with that kind of result? The 4% increase in net interest income, in gross terms, our interest income actually significantly increased by close to 50%. And a big part of that is the balance sheet growth that Joshua has spoken to. While when we get to the balance sheet, you may see that our loans actually, kind of stayed stagnant or reduced by about 2%. The average lending during the period, we saw customers, do much shorter term kind of facilities, and therefore our average loans actually increased by 7%. And then there was the other part to that, which is a pricing increase. And there was a piece of that that was negated by the higher cost of funding. And we would all know that interest rates have been elevated, and therefore, on the deposit side, there was a paying up to obtain some of the deposits to facilitate lending. So that's what led to the 4% increase in net interest revenue. On the non-interest revenue, we saw kind of a 4%, 5% reduction in fees and commissions. The trading revenue saw a much bigger reduction year on year. And a big part of that is two big things. One, we had a major transaction in the first quarter of 2023 that hasn't repeated yet. So we are working on opportunities to see something similar, but we're yet to close such a significant transaction. The second thing that we saw impact our non-interest revenue, trading revenue, is margins. Margins got significantly reduced during this period, and a big part of that is also what we've seen in the markets. Operating expenses, we managed to cut back on operating expenses year on year by about 600 million, from 8.7 billion in the first half of 2023 to 8.1 billion. Now, that does not in any way signify a slowdown in execution of strategy, or neither does it signify a slowdown in investment. In fact, I'm glad Joshua touched on some of the significant investments we've continued to make on our mobile digital interaction channels, the SBGS investment app, which is quite good and helps us kind of facilitate investment in both fixed income and equities. We've deployed a more improved Chama app, so that level of investment continues. But because of some base effects from investments in the past, we saw that number reduce, and that, of course, then helps in terms of the total outcome. Impairment is another good story. Yes, this continues to be a difficult environment, but we saw our impairments cut back by about 22% in the period. Again, there's a base effect issue there in terms of some of the impairments that we took last year. But then the big story for the first half of this year has been about the curing of some of the names and working with our customers to cure some of the challenges that they've had. And the environment continues to be challenging, but therefore staying close to our customers and working with them continues to be premium for us to be able to sustain that level of lower than market impairment. That gives us a profit after tax of 7.2 billion, which is 2% up year on year, and adjusted for all the base effects that we had in the prior year, both on the cost side and investment, revenue. That is actually a very good performance. Net interest margins in terms of the key ratios got depressed, and I spoke to cost of funding earlier. And as we've shored up our local currency liquidity to support the close to 30% increase in local assets that our customers are demanding, we've had to pay up a little bit of that. Again, this is a market environment issue, and we're having to navigate that. Credit loss ratio, glad to see that ticking lower, 1.3%, despite the challenges that exist in the market. And that's really just a reflection of our interaction with the market and our customers. Cost to income ratio at 40.4%, quite pleased with that. Demonstrate the efficiency and mining and extracting outcomes out of the investments we've made in the past. Our return on equity, safely above 20% at 21%, quite comfortable with that. Of course, the chairman spoke about a 60% increase in the dividend that the board is pleased to declare. Looking at the balance sheet, a 30% increase in our total assets. Quite pleased to see our balance sheet expand by about 110 billion over the last year. A big part of that boosted by deposits. If you come to the middle column, deposits up close to 40%, and a lot of that has been showing up on the local currency deposits to support the customer assets demand. Now, when you look at customer loans, you're wondering, where did you take the 39% that you raised? And that's what the CE was explaining, to say a lot of that has been to support local currency assets, which have grown to by close to 30%. But then we've seen almost an equal and opposite reduction on foreign currency. And there's a part of that is foreign currency loans being more expensive because of US rates, US dollar interest rates being on the higher side, and therefore customers choosing to kind of carry local currency credit, so repaying that. There's currency appreciation, which has also had an impact. But there's also a big part that is the oil and gas sector, which we support. Previously, you would remember that was in foreign currency. It's now local currency, and therefore we've seen a lot of that credit replaced with local currency credit. Our NPLs increased by 2.5% in gross terms. And the NPL ratio is now at 9.44%. We've kind of been around that 9% area, so 9.18 in the middle of last year, 9.47 at the end of 2023, and 9.44 now. So we continue to operate around that area as we work out and deal with some of our some of the and non-performing loans that we've had in the past. We've managed to cure some, but the ratio is not necessarily improving, and a fair part of that is also the base effect, because it's a function of the denominator, which is the customer loans that haven't grown as much. Quite pleased to see our loan to deposit ratio continue to improve despite a difficult, deposit taking environment in terms of rates. We are 66%, which is within the area that we like to operate in. Sufficient on capital and quite sufficient on liquidity. Looking at how the house comes together, we've got different operations. We've got the bank as legal entity, has operations in Kenya and operations in South Sudan. There's a bank assurance intermediary, and there's a securities facilitator or exchange facilitator. The bank operations recorded a 3% increase. A big part of that is the balance sheet growth that I've spoken to, and there's also the effective risk management and cost management that I've spoken to. South Sudan continues to do a very, very good job and deliver very good results, more than 100% year on year. Very, very resilient trading activity in South Sudan, as well as also effective risk management and cost management. And this comes in a tough operating environment that has been painted. So this is quite good to see and pleasing to see coming from our individual businesses. Very pleased by our bank assurance business, continued to help clients intermediate or facilitate clients to acquire protection from insurance companies, mining off of the bank's ecosystem, but also doing standalone products. So 20% growth from the bank assurance business is quite pleasing. The last business is SBG Securities, 91% down year on year, not a problem. This is the business that led the intermediation of the big transaction that I spoke to from last year. It is also a business that is investing in new diversified opportunities, and therefore 91% reduction for a business that is coming off such a strong big base is great to see. In closing, and going back to our strategic pillars, and this is how we look at the business and tell ourselves whether we are doing the right things or there's something that's off. When I reflect about our client focus and people engagement, staff engagement, we continue to see strong performance across the various revenue lines, and we continue to navigate market challenges and take opportunities as we see them to deliver the strong balance sheet growth that we've seen. We continue to invest in improving operational efficiencies, providing new channels and improving our current digital channels to facilitate customers to be able to transact and go along with the economic activity conveniently. We continue to focus our efforts on risk management, which is important for us to safeguard the shareholder value. And talking about shareholder value, we continue to see an increasing shareholder return as depicted by the picture on ROE. And we've seen our return on equity improve year on year over the last 5 years without fail, which is something that we'd like to continue doing. And yes, while we do that, we continue to pay dividends and appreciate our shareholders for trusting us with their capital. And the last thing is we continue to have a sustainable community engagement model that ensures that we are legitimate and we are living our purpose, that Kenya is our home, South Sudan is our home, we drive her growth. Thank you very much for listening to me. I'll now invite Lillian to take us to the next, please. Thanks.
Thank you very much, our chairman, Joe. Thank you, Patrick, Dr. Joshua, CE, and Dennis for walking us through. I think our results are a reflection of our growth journey, our resilience in a very uncertain market. But I think we are soldiering on, and we would like now to move to the question and answer section. And as we move into the question and answer section, kindly allow for a 2 minutes intermission, just so that we can have the panel on stage. Just 2 minutes intermission. Thank you.
My entrepreneurial journey began in the year 2016. My friend had opened a bar, and she wanted someone to supply snacks. So she approached me and asked me if I knew someone who'd deliver. She wanted samosas. We had never made samosas before. I went online and got a lady. I asked her if she can train me how to do the whole process. The samples that we did, I took to my friend, and my friend liked them, and that is how she gave me the job. After that, I started posting samosas online. I got a lot of orders from friends. They were my first clients. And I told myself, why not introduce more snacks, more variety. Then just before COVID, I told myself, let me get fish and sell to my neighbors. I remember there was a client from Syokimau. So the client was like, Jackie, where can I get the fish? I want to come and pick them myself. So I had that choice of, am I going to let people come to my house, or am I going to get a small place and just start from there? So we started scouting for a restaurant. We got a place just in Kitengela, and it just progressed very smoothly. Then COVID hit, the restaurants were closed and all that. After COVID, we opened our doors again, and we got a lot of referrals, and we saw the need of us moving from where we were, because the sanitation wasn't proper for a restaurant. So we began scouting for land. That's how we came to our new location here in Kitengela. I managed to get funds from my sources and put up the structure. But still, I had that need to have more financial aid. And I approached a friend who then recommended Stanbic. I walked to one of their branches and I spoke to the manager, who then took me through the products that are suitable for my business. And I managed to get one, and Stanbic came through for me. Through their financial assistance, I've been able to employ more staff. So that has really contributed to more orders from corporate, and I'm able to deliver timely, and this has opened more opportunities for the business.
The thrilling world of businesses in the city. Mato, you can speed dial. Looking for help with his LPO, he needs to deliver laptops fast. Enter Stanbic Bank, the game changer in LPO financing. Anna get quick expand his horizons. Who you up with me max? Aki import bills. Lakini, you go in a tight fix, like his favorite pair of tight sweatpants. Working capital solution from Stanbic Bank in a come through. Sasa and expand his fashion empire to the max, literally. When our dada, a mobile money super agent, gets frantic calls to Hawana Float through our digital solution, MJK Dada Boss can send floats to a sea of agents to keep them all afloat. Grow your biashara and unlock your horizons with our payments and collections, vehicle and asset financing, unsecured bid bonds, LPO financing, insurance, cross-border solutions, and so much more. Stanbic Bank is regulated by the Central Bank of Kenya.
Thank you very much and welcome back. Thank you for sending through your questions. I do have my panel here. And the first question is to our Regional Chief Executive, Patrick. Patrick, several questions coming through with this theme. In the last briefing, Stanbic Holdings, CE, I guess referring to you, mentioned that the market was experiencing turbulence and thus not a good time to consider a merger or acquisition. Has the board reconsidered that decision in maintaining in your growth strategy?
Thank you. Thank you for that question, Lillian. First of all, when we think about our growth, we think about it more on a regional basis. And I think one of the things that is probably least known is that we're now the number 2 bank in the region. And we've done that organically. So there's absolutely nothing wrong with having an organic growth strategy, particularly when you're growing 30%, loan book like we've just demonstrated in Kenya. So our strategy at the moment is that we do need to see stability in the sector, in the Kenyan sector in particular. We just talked about NPLs close to 20%. There is a lot of turbulence still, and I think I will say that we'll need to see at least a couple of quarters of some stability around, client growth, NPLs, balance sheet, etc. But the overarching strategy of being, the number 1 regional bank will remain, and I would say that we're very, very happy that we've been able to attain that number 2 organically. But we'll still have aspirations to be in the top 4, top 3 in Kenya. When an opportunity arises, it will arise. But for now, we'll just keep doing what we're doing, and it seems to be going okay. Thanks.
Okay. Thank you, Patrick. The next question is to Joshua. Joshua, Dr. how does the current half-year performance align with your long-term strategic goals, and what adjustments are being considered so that you stay on track?
Thank you very much. So I would say that I'm actually quite confident on the journey. When you take a much more 3-year horizon, you tend to look at what are your growth drivers in the medium term. So every quarter, our performance is quite steady from quarter 1. And I would say if you look at the general challenges on the macroeconomic environment, we've been able to study and work closely to be able to remain on course. So it doesn't change the momentum we have. So a 2% growth in our overall returns actually is consistent. Musao mentioned earlier, if you look at, and maybe just to explain clearly, the person asked the question, if you look at last year, we had a very significant transactions which were advisory. And that was 20% of our earnings in the previous year. So actually, if you rebase it, we are up 18, 19, 20%. So that's really important to reflect on that kind of comment. Because sometimes you need to explain, okay, what is the result like? So if you reset that, then we are on course. If you look at our growth in terms of our assets, it's very solid. We've grown our liabilities very strongly in the first half of the year. It's a 30% growth in our balance sheet. And I also talked about our more than 30% growth in our local currency loans to clients. So I'm quite confident in what I see. And lastly, Lillian, the environment is improving. So if you look at where we got here in terms of high interest rates, It's not just a Kenyan challenge, it's a much more global. And Patrick mentioned earlier that we see advanced economies adjusting the interest rates. We're also quite pleased with the signal from our own central bank in the last MPC meeting to be able to adjust their rates. So that is the season, and the business has to be very dynamic. So we remain resilient and solid that we'll be able to achieve our ambitions, both in the short term, but also in the medium term.
Okay. Joshua, allow me just to come back to you on another question. I think you spoke about the customer deposits. And the question is, are there any specific interventions or incentives you made in your half year to drive these customer deposits?
Well, this is not really, Lillian. I would say if you spoke earlier about our growth in customer numbers, right? So we've been engaging much more closely with our clients. If I remember, we had a very, very solid engagement with our clients. We had a campaign that we were running, which was organizing our customers and support. I also want to speak that we are doing much more with our private and personal banking business. So that's where we see a lot of work in terms of our growth coming from in the medium term. So, if more clients are coming and saying we're happy to work with the bank, we're pushing the growth ambitions we have, that's where I will see a lot of activities we see. And that for me is exciting to say, not intervention we need to make, but by aligning our client experience, by making sure that our NPS and satisfaction levels are increasing higher. Lillian, I also remember that we had one of the highest scores in our customer satisfaction for our wholesale clients. One of the highest I've seen in the last 10 years. So that's a lot of confirmation and confidence that our clients are actually staying with us because of the services we offer and the solutions we provide. So that is what I'm excited about, and that gives you a good momentum for the growth for the medium term.
Allow me to go back to Patrick before I go to Dennis. Patrick, please explain the rationale behind the 60% increase in the interim dividend at a time when the pre-provision operating profit was lower year on year and your PAT was largely flat.
Two things. One is that we've set a target of a 60% payout ratio for dividends, and something that we want and intend to keep that promise. Secondly, we do not like to hold on to excess capital. If we don't need the capital, we can always pay it out. We appreciate our shareholders for being supportive, and therefore we felt like it was worth, if we did not need that capital, to actually pay it out as a dividend. And lastly, I think, at the end of the day, we do have a very good story to tell. We have a very good trajectory in terms of our growth. Joshua just talked about some of the things that we're seeing. We feel very confident about our future, and therefore quite confident that we could pay out that 60%. Thank you.
Okay, Dennis, let me shift gears to Dennis, our CFVO. Dennis, the question is, can you please comment on what investments you hold in government bonds, treasury bills, and Eurobonds, and how this has grown year on year? Can you also explain how you would potentially structure your balance sheet to limit any impact from government debt restructuring?
Thank you for that question. So our balance sheet is, call it 500 billion shillings, 498, as at June. Our total government investments holding is around the 50-60 billion mark, which is about 10%. It is, and I know we've said this before, it is largely a liquidity play. There are regulations as to what ratio of your asset base needs to be in liquid assets. We treat, or we consider, government securities as one of those portfolios, and therefore we would keep a portion of those assets in that portfolio. When we think about our strategy, the number one priority for us is to prioritize deployment of any available resources to client franchises, and that is demonstrated by the consistent growth we've continued to see on our customer type assets, and some of which I spoke to earlier, and that continues unchanged. Now, as risks arise in the market, the business we are in is about risk taking, whether you're taking risk on or whatever class of assets that you have. We monitor and we navigate through those risks to ensure that we have sufficient capital, we have sufficient risk-absorbing capacity to sustain the returns that we want.
Okay, allow me to stay with you for another question. Non-interest income question. The question goes, can you elaborate on the key drivers behind changes in your non-interest income and how sustainable these trends are?
Another great question. Thank you. Thank you for that question. So I did mention earlier that our non-interest revenue went down 15%. Our non-interest revenue is comprised of fees and commissions, and the other part is trading revenue. There's other revenue which is usually relatively small. Fees and commissions kind of went down about 5-6%. Not a concern, because in that line of fees and commissions, there's a portion that came from the big transaction that we spoke to about last year. So actually, if I exclude that transaction, we're talking close to 20% increase in fees income. Where is that coming from? It's coming from the 18% increase in customer numbers. It's coming from the 9% increase in digital customer transaction. It's coming from the footprint that Joshua spoke to. It's coming from the diversified kind of portfolio of channels and products that we've released to the market during the period. So that explains that adjusted kind of increase that we're speaking about. Trading revenue is the main line that went downwards. Trading revenue, a big part of that is foreign currency trading. A big part of that is margins. We saw margins in FX, more than half, in terms of a reduction year on year. What is pleasing for us is to see that the total volumes of FX transactions we did during the period actually increased, which means that we still have the trust of the customers, and we continue to facilitate them to carry on those transactions. So for me, when I look at the landscape of the non-interest revenue, I feel like our surface area of success is expanding, because we are engaging more with customers, we're offering them more diversified channels, and we're offering them more diversified solutions. And therefore, and the bump on the road, which is what we see in the H1 results, is not necessarily something to worry about.
Thank you. Thank you, Dennis. Let me shift gears to Dr. Joshua. Joshua, kindly expound on your credit appetite and lending opportunities in the current tight operating environment and the outlook in half two of the same. And as you respond to that, there's a second part to the question, which says, can you also explain the strategies undertaken to manage your asset quality at the 9% levels?
I would say that we remain, obviously we have a very good track record in terms of how we managed the kind of asset we're taking in our portfolio. So obviously our NPL ratio doesn't come in just as an outcome. It's because of the very strong assessment models we have. We have a very solid credit assessment teams and even client-facing teams. So that's one of our strengths for a long time. So even in the second half, I would say that we remain with the same kind of posture. That is not going to change in our view. We perhaps have one of the best NPA ratios in the market. So, and if you look at the cost of risk, is actually been the credit risk that's come in much lower compared to where we are targeted for this year. So just to answer the questions, obviously, and Patrick mentioned earlier, the industry growth for credit has come much lower, private sector credit, to more like 4% or 5%. It's one of the lowest we've seen in probably in the last 10 years. But this tends to happen, if you ask me, because of high interest rates. And so the way I will answer that question, Lillian, is to say, with the posture we see from the Monetary Policy Committee and the Central Bank, I believe that gives you a signal that rates will definitely start coming down. It's not just a Kenyan issue. This is a very global matter across many central banks. And as that opens up, you should see credit growth, in my view. And you have to remove credit growth outside the contraction of the foreign currency lending. Because what has happened in this period is that we've seen a growth in local currency, which is more like a 9%, 10%. And then we've seen, obviously, a shrinkage of foreign currency because of what has happened in the revaluations. So we'll continue with the same momentum. I also did speak about that we've 54 billion shillings of facilities in the first 6 months of the year we've been able to disperse during the period. So that, for me, will be what I would say. The second item is, what strategy have we put in place? So the way we assess our clients, that kind of posture has remained very consistent. My view is that is really the strength and excellence we have as a team, is our maturity profile as an organization across our segments. And remember, we have large clients, wholesale clients, we call them corporate and investment banking. That has been a very good area in terms of how we run. We are growing very strongly our small and medium enterprises. You saw I spoke about support to SMEs, support for housing clients, and also we've done very well in the work of private and personal banking as well. So I don't see that there's any change in the philosophy and the strategy we have, is to build the momentum and make sure that we remain cautious in the kind of exposures we take in the second half of the year. But I'm excited about the posture for interest rates. Normally, that is what happens when interest rates are high.
Okay, thank you, Daktari. I think this question goes to you, or Dennis might take this one. Loan defaults in the banking sector are rising, but Stanbic Bank has cut its provisioning for defaults. What does this mean in terms of outlook for clients?
I think what I'm about to say is kind of a part B to what Daktari spoke about. Loan defaults don't just happen. They are an outcome. They are an outcome of your credit assessment process, which we have worked very hard across the teams to try and improve. They are a function of your constant monitoring and engagement with the clients, working with them through summer and winter of business, because their businesses will go through different cycles. And that is an exercise also we've tried to work through with our relationship management model. And I do feel those two combined, there's a third pillar, which is collection activities, because some loans then will inevitably go into non-performing, and that's why we have a 9.4% NPL ratio. There's collection capabilities, both in person and technology. And those three efforts combined are the outcome of what we see. Now, what we are seeing in the industry is a lot more challenges in those kind of capabilities, and what then is required is enhanced capabilities across the industry. I think there's an important point to be made about private sector credit growth alongside the NPL ratio in the industry. When the credit growth continues to slow down to the 4% that you see, and the NPL quantum is not resolving as fast, the denominator reduces. So the 16.1 to 16.3 we saw between April and what the central bank was announced recently by the regulator is in part a function of that. So it's origination, it is monitoring, it is collection capabilities, and then there's base effects.
Thank you, Dennis. Back to you, Daktari. We recently launched our sustainability report, and the comment says, "Congratulations for the recent launch of your sustainability report. Sustainability has become a key focus for most organizations, including banks. What should we expect from Stanbic going forward?"
Thanks for the questions. It's not a new area for us, so I just want to reiterate that part of our strategy that Patrick mentioned earlier is building, a sustainable business, being able to grow and work with our stakeholders. So that has been part of our DNA as an organization for a long time. I must say this is more like a 10-year-old journey, so it's not a new one. What we are doing, is to be very much, transparent in being able to report to our stakeholders the outcomes of those initiatives. That is really the agenda for now. Whether it's about climate financing and resilience, what are we doing and how are we responding in our portfolio? Whether it's a financial literacy and financial inclusion, so that you can be able to track. And I think, Lillian, the conversations going forward is about being able to position out there the progress, similar to how you track your SDGs. Where are we towards the 2030 ambitions at global level? So I wouldn't say that it's new, and I'd like to respond to that. So our 4 priorities, I want to reinforce again, and our sustainability report is out there. It's launched, it's available online, and you can be able to Google it and find it. What you'll find from our website is that we talked about financial literacy, which is financial inclusion, largely. So, we are working very closely with a lot of partners. And some of them you saw, I spoke about our Gates Foundation partnership, bringing in between 5 to 7 women entrepreneurs in the next 5 to 7 years. We spoke about our just transition and energy transition. So in terms of how much are we bringing in energy sources for us, moving into green energy by then 2027. We spoke a little bit much more about job creation and enterprise development, which is very much related to building businesses and creating jobs in our markets, and some commitments. You think about the 5 million businesses we want to be able to support in the next 3 to 5 years. Those jobs will want to come through. And finally, in terms of climate resilience and being able to finance those kind of projects we have, those are the 4 main pillars for us in the next couple of years. And those measures is what we put out there. So, we look forward to you seeing how we are progressing. I was happy with the refocus and the launch. And so you'll continue seeing us every year. And as more players in the industry do it, the more collectively we have a better response to sustainable practice in the market.
Thank you. Just can take 2 or 3 more questions. This is to Dennis. Dennis, please explain the rise of cost of funds in the second quarter, given the interest rates were stable and liabilities were flat, quarter on quarter. What is the outlook for half 2?
Yeah, so when we show results, the comparative is not necessarily quarter on quarter. It's Q2 this year vis-a-vis Q2 of 2023. And what we saw through this period is that as we raised more deposits in an environment where interests remain elevated in the whole of really first half of 2024, and I'm glad to see the signal from the central bank, which is likely to ease that. Compare that to the base of H1 2023. It was a much higher cost at a unit level. Now, compound that with a 30% increase year on year on deposits, you're multiplying a higher cost of, interest expense price against a bigger deposits base, and that is why we saw the increase. We are not concerned. Despite all that increase, we still managed to grow our NII. The signal from the local regulator and some of the signals we are seeing from some of the global banks, starting with Canada, the ECB, in the UK, are showing that rates will potentially start coming down, and that will ease. So going into second half, much more confident about being able to manage that and maintain the returns that we've set.
Thank you, Dennis. Joshua, a question on the Supreme Court ruling. Any update on the Supreme Court ruling regarding lending rates, and how will this affect Stanbic's lending business in the second half?
So, I would say this is a matter that is still going on review. I guess we all agree with our Supreme Court has given its direction. So the engagement that is going on, not just at the bank, but at the industry level, will be able to give us some much more clarity. So it's not able to say how will that play out in the next couple of months. But there's a lot of work that is going on today to be able just to understand fully what that means for the sector. I do not think that it will affect how banks, continue to do their lending decisions. We continue to do the work in the past with the central bank and across all the players. So I would say, Lillian, that maybe it's early today to answer that questions, but we should be able to find more clarity at industry level in the coming few months.
Okay, so you'll take the last question. I think there's an interest in financial planning. So the question is, do you provide financial planning? But more, the second part to that question is, what is the status of your asset management business?
So let me answer the first part of the asset management, and then Dennis will answer much more on the financial planning. So a few months back, early this year, we did get an approval to be able to set up our asset management business. A lot of work has been able to proceed in the couple of months, and that's approval coming from the Capital Markets Authority. So we are just in the final stages being able to set that up, and I won't be able to say which date. We've set that date actually, and therefore we should be able to see us coming back to communicate to our clients, to stakeholders, to the media, when we'll be able to launch our asset management unit. And we have a lot of capabilities, if you know about our experience as a bank. We also run asset management across the group, and maybe Patrick will comment on that. It's not just our experience in Kenya. Across the group, we have a lot of capabilities in that. So in a few more months, in September, we should be able to look out that we'll be able to coming back to the markets again with our asset management. But maybe hand over to Patrick to speak about the group experience.
Yeah, I mean, we recently added what we call insurance and asset management as a fourth business pillar. As you know, we completed the acquisition of Liberty, which came with a lot of capability. So asset management is something that goes back 100 years in the Standard Bank history. And it has a lot of synergies, as you can imagine, within banking, getting wealth or excess, giving customers different alternatives for investment. So it's something that we will consider and actually are continuing to roll out across the continent to use that expertise that we've built over the years in South Africa and start to offer not just domestic solutions, but even international wealth management options for all our clients across the board. Thank you.
Yeah, I think the question on financial planning for me opens a strong canvas for in an area that we are actually building very strongly. In the business that Patrick has spoken to, our insurance and asset management business, there's a lot of offerings there that speak to investments, protection. But one interesting one is something we do called financial fitness academies. And we've reached thousands of people talking about financial literacy, financial planning, how to think about retirement, how to think about, just managing your money and minding how you spend and how you earn your money and which portfolios to invest in. And we have our teams ready in the investment arm of the business, ready to talk to you about this. We've got teams ready in the kind of insurance arm of the business, ready to talk to you about how to protect that those finances that you've earned. So it is an arm that we offer, and our insurance and asset business is out there talking to clients about financial planning and financial protection.
So just to wrap it up, let me close with Patrick. Patrick, how do you perceive the competitive landscape in the region evolving? And what differentiates Stanbic in the region from others in addressing emerging challenges and opportunities?
Well, I'll start with the first, I think, major advantage that we have. One is we're the largest financial services organization in Africa. Notice I didn't say bank, because that includes other parts of the business. So that gives us a license to win and to operate. We're in 20 countries. With also distribution centers across the globe. Significant presence in China. 25, I think our largest shareholder is ICBC Bank. So we've created, sort of an ability to leverage those relationships, not only to help with the trade corridor with China, but also the synergies that we extract from our regional clients in being present in all the East African countries. And remember that East Africa remains the most integrated region across the continent. I think on average, trade across sub-Saharan Africa is about 15% amongst each country. in East Africa in particular, and talking about the major countries, Kenya, Uganda, Tanzania, it's 30%. It's a significant advantage, one that is very, very underlooked, that helps us also to help support our clients regionally, because there's an effective natural sort of connectivity that happens between these countries. So we're very, very, very bullish about East Africa. The group is very bullish about Sub-Saharan Africa. In fact, we exceeded almost 50% of earnings last year in Sub-Saharan Africa. So we'll continue to invest in the growth. We talked about the macros. If you compare the macros of East Africa to any of the other regions, they're significantly much higher. So we'll invest, we'll use our brand, we'll use our connectivity and our expertise that's been around for 160 years. So, thank you.
160 years. Thank you very much, Patrick. Thank you for a very engaging session. I'd really like to thank our panel here. We had over 500 people logging in and listening internationally and locally. And thank you very much for all those who've joined us online. I'd like to confirm that the presentation, the press release, will be available, and the results will be available on our website in the Investor Relations page. And as we close this session, and we also have our press release, which will be distributed to our media fraternity. And as we close this session, I'd just like to reiterate what our Chief Executive mentioned. We have made great momentum. We are well placed to win, and we remain true to our purpose of driving Kenya's growth. Thank you for joining with us, and thank you for being our valued stakeholders, and thank you for joining us today. God bless.